Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Interactive Strength, and let me tell you, it's about to get interesting. We're going to unpack some financial moves and see if this company is building muscle or just flexing. This report is about some important financial things that happened around mid-March, so let's get right to it. The main point of this report is an agreement with an investor. This investor bought some special papers called warrants. Think of warrants as tickets that give the investor the option to buy something later. In this case, they're buying the right to buy more notes, which are like loans. They also got warrants to buy a bunch of the company's stock. Back in February, the company made a deal with this investor to buy these warrants, and it looks like in March, the investor decided to use some of those warrants. They wanted to buy $4 million worth of those Class A incremental notes, which are like IOUs. Because of this, the company also gave the investor the option to buy over 800,000 shares of their stock. It's like a buy one, get one free deal, but with stocks and loans. The company got about $3.6 million from this warrant exercise. Let's break down these notes. There's a discount, so the investor didn't pay full price. They got them 10% off. They also get paid 12% interest per year. The investor will have to be repaid by January 2028. These notes can be changed into company stock before the maturity date. The amount of stock they would get depends on some math involving the amount of the note, unpaid interest, and some extra fees, all divided by a conversion price of about 1.99 to 8 cents some extra fees, all divided by a conversion price of about 1.99 to us and Jafan share. Now, what happens if things go wrong? These notes have rules about what happens if the company messes up, like not paying on time. If that happens, the investor has to tell the company. Then the investor can demand that the company buy back the note. Also, if the company fails, the interest rate goes up by 8%, so it pays to pay on time. Now let's look at these Class A incremental common warrants. These warrants let the investor buy shares of the company's stock for $3.06 per share. They can do this from January of last year until January of 2032. The price they pay for the stock might change if the company does things like split the stock or give out dividends. There are rules about how many shares the investor can own. The investor cannot own more than almost 5% of the company's stock after changing the notes into stock or using the warrants, unless they choose to own almost 10%. Also, the company cannot give the investor more than almost 20% of the company's shares unless the company gets permission from the other stockholders or the price of the stock is high enough. This part just reminds us that what we talked about earlier about the notes is important to this section too. So nothing new here. Again, this section refers back to the earlier discussion about the deal with the investor. It's important because the company is selling stock and notes without registering them with the Securities and Exchange Commission. They're allowed to do this because they're selling to an accredited investor, which is someone who makes a lot of money or has a lot of assets. It also states that this report isn't an offer to sell these securities in any state where it's not legal to do so. On March 12th, the company put out a press release talking about the investor using their warrants. If you want to read the actual press release, you can find it attached as an exhibit to this report. This section lists the exhibits attached to the report, including the press release we just mentioned. There's also something called an interactive data file, which is basically the report in a format that computers can easily read. Now, what does all of this mean for Interactive Strength? Well, on the one hand, they got a chunk of cash, almost $4 million from this deal. That can help them fund their operations and grow their business. On the other hand, they now have more debt and they're paying a pretty high interest rate of 12%. If they mess up, that rate jumps even higher. Plus, they're giving the investor the option to buy a lot of their stock, which could dilute the value of existing shareholders' investments. Interactive Strength is walking a tightrope. They need this money to grow, but they also need to manage their debt and avoid ticking off their existing investors. Looking at the big picture, the company needs to be careful about how they manage their finances. The high interest rate on the notes means they need to generate a lot of cash to pay it back. The potential for dilution means they need to make sure their stock price stays high enough to avoid hurting existing shareholders. Overall, Interactive Strength is at a critical point. They have a chance to grow and succeed, but they need to execute their strategy flawlessly. Otherwise, they could find themselves in a tough spot. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.